So, Liam, a 0.75% increase, what does it mean?
Well, that's the Bank of England's interest rate, what the Bank of England charges to lend money to the commercial banks. It's the lowest interest rate in the whole economy. And of course, as interest rates at the Bank of England go up, mortgage rates also go up. Average mortgage rates are now above 6%, up sharply. And so if you've got a £200,000 mortgage, then the increase today, if it's fully passed on, which is likely to be if we do have a 75 basis point rise today, that will add, I'm afraid, £85 a month to your interest payments, which is just over £1,000 a year. And that's a pretty chunky increase. And of course, mortgages are paid out of post-tax income. So for a lot of people trying to weather a mortgage, young families already struggling to make ends meet, their wages aren't keeping up with inflation more generally, their mortgage payments, if they're on a variable rate, and there are about 2.5 million people on variable rate mortgages across the UK, then their mortgage payments will go up.
Really quite stark. However, a lot of people would say that interest rates, Bank of England, the base rate, has been very low for a very long time. Yes, it's started to tick up, but it's still, 2.25% today. By historic standards, that's incredibly low.
It is, but house prices are high. To buy a house, it's the average house across the UK is 8 or 9 times the average annual income. When I bought my first property in the late 90s, it's more like 3 or 4 times. So people are weathering mortgages now that are much, much bigger compared to their income. And so their mortgage payments are high, even though interest rates are relatively low. And, you know, I was doing some sums earlier, and back in the late 80s, early 90s, when interest rates did go up into double digits, even 15% at one point in the aftermath of when we left the European exchange rate mechanism, so-called Black Wednesday, the actual share of people's incomes that they're spending to service their mortgage is up where it was now in the late 80s and early 90s, about a third. So even though the headline rate of interest is lower, the actual cost to service those mortgages is at a historic high.
Really, really stark. What can we read into the decision of the United States Federal Reserve yesterday? They raised interest rates again by 0.75 points, up to 4%.
Well, the US Federal Reserve, their central bank, is by far the most important central bank in the world. It kind of sets the tone. It's clear the global interest rate cycle has turned and interest rates have been going up for some time. That, in fact, was the 4th successive increase of 0.75 percentage points by the Federal Reserve in a row. The Bank of England actually has been behind the curve. I personally think, I've been arguing for a long time, if the Bank of England had raised interest rates sooner, it could have got away with raising them by less, with less pain on households and firms. You know, let's not forget, it's not just about people's mortgages. Firms borrow money. Firms have to pay interest.
Yeah.
And the Bank of England's interest rate via the market for government debt, so-called gilt yields, which we've been talking about a lot in the aftermath of that mini budget, that sets the tone for interest rates for all personal loans, but also corporate commercial loans as well. So a lot of people running small businesses will have money outstanding, loans they've taken out to buy new premises or buy equipment or to finance their businesses. They'll be servicing their debt more. That will be more expensive as well. And then, of course, we've got the so-called autumn statement on November the 17th, when we are expecting tax rises. So we should be in no doubt. This is a pretty tough time for both households and firms across the UK economy.
Well, we'll be coming to a case study of one of these businesses in the country that is really struggling with these decisions in a moment. But looking at that autumn statement on the 17th, might it be the case that a tighter fiscal policy, these tax rises and spending cuts, are a signal to the Bank of England, independent as it is, to try and keep their rate rises lower, tighter monetary policy, tighter fiscal policy, leading to slightly looser than it otherwise would be monetary policy?
Yeah, it's important we unpack these ideas. You know, people across the country are wondering what's going on with the economy, and the ideas you've just put out there are complex. So let's just quickly go through them. What you're saying, Tom, and I think you're right, is if the government shows some fiscal restraint, if it shows some restraint with its spending, if it raises taxes to try and get in more revenue, the Bank of England may think that that will mean lower inflation, less money sloshing around, less spending going on. So then the interest rate rises, and I think there'll be more interest rate rises after today, will be fewer. And so interest rates, which could end up today at 3% at the Bank of England, they could peak at like 4 or 5% rather than 6 or 7%. And that's certainly what the markets are expecting. There are these things called forward curves. You can see, markets buying and selling loans in the future for future clearance, and you can see where people expect interest rates to go, and what we call those interest rate expectations have certainly come down. That's why, Tom, even though the Bank of England's interest rates are going to go up today, I've been saying on GBNews over the last week that lending rates overall could be coming down. And that's because when you get a 2-year fixed mortgage or a 5-year fixed mortgage, it's priced according to these interest rate expectations. And there will be some pain, I think. That's what the Treasury's briefing on November the 17th. But it may be, as you say, one silver lining of those clouds may be that rates may peak at a lower level than we previously expected. So when you get your 2 or your 5-year fix on your mortgage, I mean, we've got 8 million people on fixed rate mortgages, 2.5 million on variable, but a lot of those people on fixes, they'll soon be variable again. They'll still have to refix. So the fix may actually be lower than we thought it would be just 2 or 3 weeks ago.
Really interesting stuff there. Liam Halligan, thank you for unpacking that for us all there. Really important stuff.